In this video, we are going to talk about Charlie Munger's investing advice. So before starting this video, please like this video and subscribe to this channel for our future updates. There aren't many people in the world who are like Charlie Munger. Munger, who is 95 years old, is vice chairman of Berkshire Hathaway, NYSE, BRKA, NYSE, BRKB, and Warren Buffett's business partner. Despite the fact that Munger does not receive as much attention as Buffett, his investment strategy is said to have had a significant impact on Buffett over the years. Here's a roundup of some of his best tips. Number 1. Spend each day trying to be a little wiser than you were when you woke up. Munger is a voracious reader who devours everything he can get his hands on. He has long advocated for people to continue reading and learning throughout their lives, rather than limiting themselves to a single topic. He's talked a lot about how different disciplines collide and teach one another. Munger understands that intelligence accumulates over time. I constantly see people rise in life who are not the brightest, or even the most attentive, but they are learning machines, he continues. They go to bed every night a little wiser than when they woke up, and that helps a lot, particularly when you have a long run ahead of you. Number 2. Invert, always invert. Munger prefers to approach problems from the opposite direction. He assumes that selecting winners is less important than avoiding losers when it comes to investing. It is easier for him to prevent mistakes than it is to directly aim for results. You must remain alert of emerging risks that might derail your assets while you attempt to keep your stocks for the long term. Rather than looking for proof that your investment thesis is right, as many investors do, you will be best served by looking for proof that you are incorrect. Number 3. The number one idea is to view a stock as an ownership of the business and to judge the staying quality of the business in terms of its competitive advantage. The vast majority of market participants regard stocks as pieces of paper to be exchanged rather than a claim to a company's underlying earnings. Short-term price fluctuations, rather than the success and prospects of the underlying firm, provide these investors with information about their investment decisions and the company they have purchased. As a result, a drop in stock price would mean a deterioration in a company's outlook, and vice versa. Effective investors, on the other hand, recognize that stock values are sometimes irrational and can bear no resemblance to a company's true value. A company's share price must represent the profitability of the business and the company's potential profits in the long run. As a result, a company's quality should be assessed in terms of its competitive advantage, the factors or characteristics that enable a company to manufacture goods that are more affordable or of higher quality than its competitors. Number 4. All value investing is intelligent investing. This quote from Munger gets straight to the point. If you aren't investing according to basic valuation values, you aren't investing at all. Munger's words mean that you can only make a true investment if you have the right data and logic, as well as a reasonable price that provides a margin of protection. Putting money to work in some other way is speculative by definition. Number 5. A great company at a reasonable price is preferable to a reasonable price at a great price. The target for investors who use a value approach to investing is to find stocks that are selling for a low price. However, low-cost stocks are often cheap for a reason, and what appears to be good value turns out to be a value trap for the unwary. Meanwhile, many value investors avoid looking at high-growth stocks with high valuations because they believe they are incompatible with their investment strategy. Munger's quote, on the other hand, highlights the true essence of value, emphasizing that businesses with the best prospects are always worth buying even if you can't get them for less than their fair value. Price is important, but quality is even more important. Strong companies will compound wealth at a rapid pace over a long period of time. An investor who buys an average company at a discount, on the other hand, can only expect mediocre returns from the investment and will be better off selling it once it hits its fair value. Number 6. When it comes to saving, we have 3 options: yes, no, and too difficult to comprehend. Munger, like Buffett, wants simplicity in the companies he invests in. He is not afraid to admit that a company is too complex for him to comprehend. He easily moves on to the next nominee if it isn't clear that a business is a successful investment. Similarly, he argues that over-diversification is a form of insanity. When the best ideas should get the majority of an investor's attention, Munger never saw the point in buying more stocks just for the sake of diversification. According to this viewpoint, if an investor genuinely understands his or her investments, he or she will reap greater benefits. When an investor can explicitly and succinctly justify his investment thesis, risk is significantly reduced. Number 7. The big money is in the waiting, not in the buying or selling. Munger is a long-term stock picker. The basis of his strategy and Berkshire's remarkable success is buying great companies and keeping them for many years. The first law of compounding, according to him, is to never disturb it excessively. Yes, you can get lucky and make a fast profit on a stock in the short term. However, this pales in comparison to the long-term benefits of compounding your money. Holding positions for at least 3, 5, or 10 years, rather than selling in and out of stocks, is what it takes to achieve those kinds of incredible returns. Number 8. It takes a special kind of character to sit with all that money and do nothing. I don't get where I'm going by settling for second best. Many investors find it difficult to simply keep cash and wait for the right opportunity to present itself. This is especially true during a bull market, when stock prices continue to increase. When you see other people making money in a strong market, you can get a serious case of FOMO, fear of losing out. As a result, some investors hurry to invest and end up buying stocks of smaller companies or at exorbitant prices. Munger, on the other hand, knows that success necessitates being careful but still being competitive when the time comes. A lot of opportunities in life seem to last for a short period of time, due to some temporary inefficiency, he says. Very good investment opportunities don't come along very often, and they don't last very long, so you have to be ready to act and keep an open mind. However, in order to move quickly, you must occasionally be willing to sit still. You must be willing to sit on cash from time to time in order to be able to move quickly and seize any opportunities that arise. Number 9. Our experience appears to affirm a long-held belief that being prepared to act quickly on a large scale, on a few occasions in a lifetime, in doing something straightforward and rational, can always significantly increase the financial results of that lifetime. Finally, there is a clear formula for investment success. Invest in a few nice stocks that you will keep for a long time. Live within your means so that you can spend, and when these opportunities occur, do not be afraid to invest large amounts when the chances of success are stacked heavily in your favor. When done correctly, you can't help but amass large sums of money over time. Number 10. Don't be afraid to sell your things. Munger's ability to accept when he's wrong is one of his biggest assets, according to the man himself. A large portion of the Munger fortune came from liquidating products we initially bought because we were wrong, he told investors. You must, of course, learn to change your mind when you are mistaken. This isn't the same as selling a stock because it's already gone up a long way. Many buyers, though, do just that. They'll take a 50% or 100% benefit in the short term in exchange for missing out on something far bigger over a few decades. It's important to scrutinize all of your assets and sell as the thesis shifts. Many investors will not, and will adhere to obsolete philosophies, such as selling when the stock reaches break-even. Number 11. Put off pleasure for a while. Charlie Munger's advice on how to become wealthy is as straightforward as it is effective. All you have to do is postpone gratification for decades, resulting in a significant savings rate. Put the money to good use in excellent investment opportunities, and you'll do just fine. Even if you don't end up as a billionaire like him. The key is to prevent consumption today, which is difficult. Particularly for those who are struggling to make ends meet. There are two options for closing the savings gap. You should take Munger's attitude and look to make more money, as he did when he was younger. Munger dabbled in real estate growth in addition to becoming a lawyer in the 1960s. You may also become more frugal, which is something that most of us can do anyway. Whatever strategy you employ, the most important thing is to establish a high savings rate today and then put that money to work. Give it a few decades to compound, and you'll be able to have a lot of fun. The bottom line. Charlie Munger is 96 years old and still offers some of the best financial advice available. It just goes to show that the most important laws aren't always the most complicated. What do you think about our video? Did any of above advices help you? Let us know in the comments below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.